What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Savanovich. I work as a trader slash investor at Spoonbill Partners, LLC. We trade stocks, bonds, derivative products, private and public markets, you name it, and we've probably traded it. So for today's episode, we're going to talk about mainly one thing. I'm going to touch on a couple of things to start. We're recording this episode on Tuesday because on Wednesday I've got a bunch of other stuff scheduled in the afternoon. Typically I would do it Wednesday because you get a little bit more news by the middle of the week. We have more things to talk about on the show. But unfortunately this week, just given how the schedule worked out, I'm going to have to record this on Tuesday. We don't have a ton to talk about. So far this week, it's been mainly about earnings. We got CoreWeave after the close today. Nebius is going to be tomorrow. We got Upwork yesterday. We got On Shoes yesterday. Kava after the close today. So a bunch of big ticket reports, some larger cap names. We got big news out of Intel. They announced that they were going to raise $15 billion via a equity offering, a dilutive equity offering. And then the next day, they actually priced the shares at 95 and raised $20 billion. They upsized the deal. I was reading somewhere that it was 4 to 5 times oversubscribed. The stock actually traded pretty well today. They priced it at 95. I want to say that it opened around 96.50 and then traded up to 97, and it sort of stayed at that 97 area most of the day. So it traded very well. On I think was an interesting one. The guide was a touch soft, and you pile on top of that the fact that oil is so strong right now based on what's going on in Iran. There continues to be some drama with the Strait of Hormuz. And oil being so high is typically a headwind to any sort of retailer stocks. And so you saw weakness in Under Armour, in Nike, in Abercrombie and Finch, so many others, and on obviously was down 20% on its report. And so that little oil piece definitely exasperated the weakness in that name and in that group. And in general, athleisure and sort of sports stuff, sportswear has been really weak this year. Kava looked like guide is okay. They might be sandbagging it a little bit, but that might be fine because the price action of this stock going into this quarter was so poor that might be okay. We'll see how it trades tomorrow. NIQ was a phenomenal report as well. Gapped up a crazy amount on the open. I wish I'd bought that stock in the pre-open session because I was thinking all morning like, God, that was such a good report. But I didn't buy it because there's no volume trading. I think it was a few thousand shares traded, and it's a $12 stock, so you really need to buy a good chunk to make it worth your while. And I think the stock ended up going up a few dollars on the open anyway, sort of traded like a $50 name as opposed to a $14 name. But anyway, doesn't matter. That's enough about those little earnings tidbits. Let's move on to the big ticket item on today's pod. We're going to talk about NVIDIA and this latest MOU with some large Wall Street banks. So I just want to start by saying I thought it was absolutely comical, laughable. I was sitting here at my desk. It wasn't today, it was yesterday. Yeah, I think Monday, I want to say, I think it was after the close. I was sitting here, I was going through a couple of the names that were reporting after the Monday close. I was reading some of the reports, and then obviously I had CNBC on in the background. And I look over and I see like Jensen talking, and they actually have him in the CNBC studio. So I know it's probably something new. And so I kind of turn my head and look. I didn't even bother to turn the volume up because I don't really care to hear what he has to say too often anymore. It's usually just the talk of the town the next day. So I read it the next morning. But he's sitting there with a bunch of these other. I recognized Solomon from Goldman Sachs. And I was like, well, what the heck is going on? And the reason why I say it's comical and it's laughable is because Jensen sort of from day one on this whole AI thing, he's sort of been the star boy. He likes to wear his leather coat and he likes to have his hair kind of slicked back and he likes the, gray. I think I'm like a silver fox kind of thing. And I'm, the CEO and founder of this company that has done incredible things for AI. And I am the cornerstone of what AI is. And I build the foundation of what AI is going to be built on top of. We all understand he's got that little bit of aura. And so the reason why I say it's comical is because I'm sitting there watching these guys sit around this table, and I know, or at least I think I know who Jensen thinks he is in the AI ecosystem. And I see this frame and I think, gosh, it's so funny how they've managed to make him look like he is Jesus Christ sitting at this Last Supper table with all of these guys. And once we go through the MOU, you're really going to understand that yes, this might be the Last Supper for AI. In the spirit of this podcast, truly makes zero sense. So let's go through what this MOU is with these banks. NVIDIA signed this MOU with a bunch of firms. I'm just going to read it because I have it listed up there. I'm not going to remember all of them. Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to build a $500 billion debt financing pipeline. So what does this mean? So instead of neo clouds or cloud providers or hyperscalers using their own cash and their own free cash flow to build out data centers or invest in this technology, effectively avoid using their own cash to buy GPUs. What's going to occur now is that these private credit funds are going to lend them the money. And what's interesting about this whole thing is that NVIDIA is offering a partial residual value guarantee, so up to 25% of the value of the GPUs to sort of backstop if the borrower defaults or the value of the chips absolutely crash. The issue with pledging your GPUs or AI tech infrastructure components, pledging that kind of stuff as collateral for a loan to continue borrowing, to continue to buy more GPUs. The whole issue is that these things have a very, very short useful life. They depreciate very quickly. And through this MOU, these, 6 banks and NVIDIA are trying to reclassify this tech hardware from rapidly depreciating tech asset into sort of a more durable long-term asset. Think of something like a pipeline or a bridge or something in terms of like a city, which makes absolutely zero sense. Toll roads continue to make money. Fiber networks, cell towers. I mean, you name it. Like these things do sit there for a long time and continue to make money in perpetuity for a long time into the future. So pledging those things as collateral for a loan makes perfect sense because they're predictable to some degree. And the useful life is not 3 years. It's 20, 30, 40, 50 years. So reclassifying these tech hardware, these GPUs into something that's comparable to that is almost like sinister. It's deceptive. Frankly, it's sort of a lie because none of these GPUs are lasting more than a few years. And even if they do last 5, 10, 15 years, let's say that they do, new chips are coming out every year, it seems like. So if I go and spend billions and billions of dollars on Blackwell GPUs today, there's already Rubens out. And then so I have to spend another few $1 billion. I need to borrow a bunch of money, pledge my Blackwells as collateral, borrow a bunch of money, and then go buy a bunch of Rubens. 1 year after that, there's something new from NVIDIA. And so what, do I have to sell the Blackwells at some massive discount and then try and buy whatever the new chip? Like it makes absolutely zero sense. There's new technology coming out so quickly, so rapidly. If you're a neo cloud or if you're a hyperscaler and you want to have the cutting edge tech and you want to buy the best chips available at any point in time, it doesn't really matter if you can reclassify these things into assets that last 15 to 20 years because you're going to be buying a completely new set in 1 to 2 years. You understand what I'm trying to say? The useful life in practical terms is only a couple of years because you're not going to want to use Blackwells past year 3 when there's already been 2 years of new chip technology coming out, even if they're still usable. If you're a hyperscaler and you want to compete, if I'm Google and I want to continue to compete with Meta, with Microsoft, and with Amazon, and they are buying the newest chip technology, I'm not going to sit on my Blackwells for longer than a couple of years while there's other new technology in the marketplace that my competitors are rushing to purchase. So the whole thing is sort of a sham. It doesn't make a whole lot of sense. I think NVIDIA's angle is it offloads this circular finance or vendor financing off of their balance sheets. It protects their free cash flow and it allows them to do things like repurchasing a bunch of their stock, i.e. returning capital to shareholders, whilst also maintaining this extremely hot GPU demand. So they're really getting the best of both worlds. Jensen is pitching that a GPU is like a toll bridge that's going to generate fees for 30 years, which is completely not true. A toll bridge isn't going to become obsolete in 24 months after you've built it. It's going to sit there for a long time. A GPU is a rapidly depreciating consumer durable product. When NVIDIA drops its next generation chip, this one's going to become obsolete. That's what I just said. And the prior generation's market value is going to drop off a cliff. If you think that a Blackwell is going to retain 80% of its value when the Rubens start to get shipped, that makes no sense. That's not going to happen. And so what makes this really dangerous, Wall Street is underwriting 5 to 7 year paper on hardware that is effectively has a useful life of 3 years and might even be obsolete before the 3 years is up. So if this is a little bit confusing for you, they're underwriting loans secured by assets that have a exponential decay function in their value. And these loans are traditionally meant for assets that have a linear decay function in their value, meaning they go down the same amount every single year. But that's not the case with GPUs, given how rapidly quick the technology advances. How bad this looks for NVIDIA, like you just came out of this sort of AI semiconductor sell-off. The market, bounced back, but there was this spook in the tape and all of these names got sold off and people were starting to question the demand for GPUs. This is just another mechanism for NVIDIA to manufacture, like synthesize its own demand. If a company like a new neocloud or a startup can't raise money from a VC, or if they can't get the money and they don't make any money, what can they do to buy NVIDIA GPUs? Well, NVIDIA is starting to figure out that, Wall Street's not rewarding them for doing these circular finance deals anymore. So what can they do that's the next best thing? Well, let me introduce you to my 6 friends on Wall Street who I just signed an MOU with that are willing to lend you money. You purchase my GPUs, and then you put those GPUs up as collateral, you get the cash, you have this giant loan out for the next 5 to 7 years, and don't worry, I'll backstop up to 25% to protect the lender. Like, you understand how crazy that sounds? NVIDIA is manufacturing this entire thing using Wall Street's money because I have a sneaking suspicion that Jensen doesn't really want to be the one to underwrite all of these vendor financing deals anymore. Now, here's the other thing that people aren't going to consider about the actual debt. They're just looking at NVIDIA. Like myself, I'm looking at the NVIDIA problem and how disgusting it is that they are manufacturing their own demand. So NVIDIA gets the money. Let's say, you're a startup and you get the money from one of these 6 Wall Street banks. You pay NVIDIA $1 million for your GPU. I don't know what the cost is, but you pay NVIDIA $1 million for your GPU. NVIDIA gets to recognize that revenue right then and there. High margin revenue right then and there. It looks good for them. The private credit funds are getting high yields today. They're earning some money on that. And the risk of the underlying debt doesn't actually hit until years down the line, when the lenders start to figure out, I can't actually recoup $1 million from these guys because they don't make any money. And the collateral that they put up is worth only about $200,000 now. The whole thing smells like 2008 to me. And Larry Fink from BlackRock, funnily enough, compared this deal to the birth of the mortgage-backed security, which obviously led to what occurred in 2008. So my last 2 points, because this episode is starting to get long and I don't really want to talk about NVIDIA anymore. The entire premise relies on the idea that if an AI startup goes bankrupt, the private equity firm can just repossess the GPUs and then rent them to someone else. But if one AI startup goes bankrupt because inference software gets commoditized, then all of them are simultaneously going to get bankrupt. And who are these banks going to rent these GPUs out to? Like, the market's going to be flooded with GPUs for rent, and you're not going to command a premium price for those GPUs if there's thousands upon thousands, maybe millions of them on the market to rent. Not to mention they're 4-year-old GPUs. And then obviously this is occurring in private credit markets where marks are always inflated. They're never real marks. And bad debt is going to sit hidden on a balance sheet somewhere for years until fire sales need to happen. And then they're going to start to get marked down. And that's going to happen very quickly and all at once. Rarely do these things slowly start to trickle. When there's a problem and people start to realize there is a problem, it's oftentimes too late. Anyway, I feel like I beat this topic to absolute death. Next week, we're going to have so many other things to talk about. I just wanted to get this episode out today. I apologize if my thoughts were a little bit jumbled there. To summarize the whole thing, NVIDIA is doing whatever it can to generate demand for its GPUs. And this latest MOU is sort of the cherry on top of everything that they've done in the world in relation to vendor financing, circular financing, whatever you want to call it. This is sort of the wow, like aha moment, like this could truly be the thing that creates a bubble, because now anyone can get a loan effectively. Like if you've got a startup, you really don't need anything to get a loan from any of these six banks. You just need to say that, hey, I'm going to use the loan to buy NVIDIA GPUs, and then you're going to put those GPUs up as collateral. So I don't think that there's any credit standard. There's no standard for lending. So again, I'm going on a tangent again, but NVIDIA is artificially pumping demand by any means possible. It should frighten you that they are trying to do that now by reclassifying traditionally very short-lived hardware, reclassifying it into something that it is absolutely not. That's a lie. That's a bold-faced lie. And it might not be tomorrow, it might not be next month, and heck, I might be wrong for the next year, 2 years, 3 years, but at some point, the chickens will come home to roost, and we'll see how much a Blackwell costs 4 years from now. So that's the end of the episode. Thank you so much for listening. Make sure to follow me on TikTok, Instagram, YouTube. I post a bunch of short form content on there. I hope you have a phenomenal Friday and an even better weekend. Take care, and I will catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.